All right, friends, welcome to 4.2. We're talking about monopolies, specifically how to graph those monopolies and how to analyze those monopolies. Let's get to it. All right, so characteristics of a monopoly. You know these already from the last video, but just to recap as we're diving into this first, one large firm. The firm is the market is the firm. There's no other competition. They rule everything. Two, they have a 100% unique product, a product that is completely differentiated and that cannot be replicated, maybe because of patent law or something else. There's super high barriers to entry. It's very difficult to start your own firm to compete against them, mainly because of their economies of scale, which we'll talk about a little bit later. They are price makers. They have complete control over price. The only limitation on the price that they charge is whether or not people are willing to pay it in the marketplace. People still have to be willing to buy it if you're going to be able to make profit. Okay, and then they do some advertisement, but normally that advertisement is to reach the market and say, hey, we're here and here's how to get it. Okay, so which of the following is a source of monopoly power, my friends? Is it scarcity, elasticity of demand, barriers to entry, low profits, or free markets? What do you think? Of course, it's barriers to entry, right? If these large barrier entry exists, a monopoly can continue to operate with impunity, charge high prices for their goods, and make ridiculous amounts of profit. It is the lack of competition that gives monopolies their power. Okay, question, can monopolies be good for the economy or for society as a whole? Right? Normally you look at this and you're like, no way, right? Monopolies are bad. We are America. We know competition is important. We have antitrust laws in place on purpose. The answer is actually they can. Monopolies sometimes have incredible economies of scale. If you remember a long run average total cost curve, economies of scale mean that they can produce goods for a really, really low price or low cost, which is a more efficient use of our resources. So if they have incredible economies of scale, it might be impractical to have smaller firms take over. For example, our electricity grid, which surprisingly was in the news this year, but our electric grid run generally speaking by General Electric, generally speaking, and then redistributed portions of that electricity are bought by smaller firms. But the grid is run by General Electric. It doesn't make sense for us to divvy that up and have individual states or individual firms build their own infrastructure because it's astronomically expensive. So, yeah, it makes sense. We call those natural monopolies. And natural monopolies means it is natural for only one firm to produce it because it's prohibitive for a firm to enter that marketplace, like an electric grid. And the current firm is producing at a really, really low cost. So it's actually efficient for our economy. It's not great for competition and for pricing, but it is efficient for our economy. So the answer is yes, we should have a monopoly, but in those cases, which are rare, but in those rare cases where it makes sense to have a natural monopoly, we should probably step in and provide some regulation and make sure that our consumers are protected. Okay, so let's draw some monopolies. Here we go. So if you're drawing monopolies, there's some good news. First, there's only one graph. You don't have to draw two different graphs because the firm is the industry. Woo, celebration, right? Two, cost curves do not change. Marginal cost is still the ladle. Average total cost is still the bowl. Three, MR equals MC, profit maximizing or loss minimizing rule still applies. That's always going to tell you what quantity to produce, which is exciting. And then four, the shutdown rule still applies. When price falls below AVC, you'll shut down. But if you're a monopoly and your price is falling below AVC, you got serious problems. You probably are a monopoly over something nobody wants. All right, here we go. So what output should this monopoly produce? Okay, so notice we have our demand and our marginal revenue curve that we talked about in class and that you've seen in the last video lecture. Marginal cost and average total cost are still the same. Can you find the quantity? Well, if the profit maximizing rule applies, then the quantity is found where MR equals MC. Even though there's a lot of noise here, and maybe it's unfamiliar noise, MR equals MC still wins, which means that I'm going to produce at this point a quantity of 6. Now here's a question. Can you determine total revenue, total cost, profit or loss? Well, what price is this firm going to charge at MR equals MC? Now, most people at this point say, well, they should charge a price of $5, right? Like, I'm pretty smart. I dash this over $5. That's what they're going to charge. And yeah, that's what they would charge if they didn't have control over a marketplace. But notice our demand curve here tells us what people are willing to pay, right? People are willing to pay a higher price than $5. In fact, if I just keep dashing up to the demand curve at a quantity of 6, I'm going to be able to sell this for like $7 or $8, $7, right? People are willing to pay a higher price. And this is the first wrinkle of a monopoly. You find the quantity where MR equals MC. But remember, the demand curve represents what people are willing to pay. Now, as a monopoly, I want to charge as high of a price as I possibly can to make profit because I'm a price maker, not a price taker. So I'm going to dash all the way up to the demand curve and dash over, and that is going to give you your price. MR equals MC gives you your quantity, dash up to the demand curve to get your price. So my price is going to be $7. So what's my total revenue? Well, 7 times 6, my total revenue is going to be $42. How about total cost? Same rule applies. I dash up until I hit ATC, which is going to be right here. So my average total cost is going to be $6. My total cost is 6 times 6, or $36. So $36 are my costs, $42 are my revenues. So my profit is going to be right here. Notice my profit is the difference between my price at the demand curve and my average total cost. Just like before was the difference between the price at Mr. Dark and the average total cost, same rule applies. So this little box here is going to be my profit of $6. Not so bad. We've been building to this. You know all of these rules. We're just applying them to a slightly different graph where one firm has control over an entire marketplace. Okay, so the conclusion, monopolists will produce where MR equals MC. They will, because it's profit maximize rule, that matters. But they're going to charge the price consumers are willing to pay. And we identify that at the demand curve. Again, MR equals MC, but we dash up to the demand curve to get our price. That's the most important wrinkle with a monopoly. So what if the costs are really, really high? What are you going to do? Can you determine those same things? Okay, so MR equals MC at what point? Quantity of 10. I'm not going to charge this low price of 7 because people are willing to pay higher. The demand curve tells me that people are willing to pay, all the way up here at $9. So my total revenue is going to be 9 times 10, or 90. My total costs, though, are going to be way up here. I'll take 10, I'll dash all the way up to ATC. I'll hit ATC, I'll dash over. It's going to be 10 times 10, or 100. My total revenue is 90. My total costs are 100. Then I'm going to have losses of $10. Now let me ask you this question. Should this firm, there's your stuff, should this firm have shut down? Well, if you just look at this at a glance, we have AVC here. You're like, well, MR equals MC right here is below AVC. Maybe they should shut down. Maybe the price is below AVC. Maybe the fixed costs are greater, or less than the losses. But remember, I'm not going to charge this low price of 7. People are willing to pay higher, so I dash up above AVC. Remember, it's price versus AVC, not quantity. My price is 9 when AVC is 8. I should still produce even though I'm producing at a loss. Okay, let's try another one. Go ahead and pause the video and see if you can calculate these things. Okay, did you pause? No way for me to tell. All right, so what is the quantity that I'm going to produce? Well, I'm always going to produce at the quantity where MR equals MC. So I find that. It's right here. That's the first thing you got to do every time you see a monopoly. MR equals MC. I dash down my quantity is going to be 5 then. I'm going to produce 5 because of my profit maximizing quantity. Now, what price am I going to charge? Am I going to charge this measly old price over here of $6? Maybe if I was a perfectly competitive firm, but I'm a big fish. This is a monopoly. I'm going to charge a much higher price. And I know that price is given to me by the demand curve. So I just keep on dashing up until I hit the demand curve. And I dash over, my price is going to be $10. So what's my total revenue going to be? It's going to be 10 times 5, or $50. What about my total cost? Well, I dash up from my quantity until I hit my total cost curve. My total cost curve, that's total revenues. My total cost curve is going to be right here. I dash over, and my total average total cost is going to be 5, which means my total cost is going to be 5 times 5, or $25. Little box right here. Remember, the difference between price and total revenue and my total cost, or price and average total cost, is going to equal my profits or losses. So this is my price. That's my average total cost. That difference is going to equal my prices. That difference times my quantity. So my profits are going to be 50 minus 25, or $25, this green box right here. What about my profit or loss per unit? Well, I just take that $25 and divide it by the amount of units I produce, which is 5, and that gives me $5, or the difference between my price and my average total cost. Not so bad, right? Hopefully. Let's try one more. I'm going to do a format switch for you. Just flip it around. MC equals ATC. We're going to make it fixed all the way across. Just fixed cost for this monopoly. Can you identify these here? Pause. Unpause. First, find MR equals MC. Even though it's different, the rules still apply. So I go right here. MR equals MC right here. My quantity is going to be 6. I'm not going to charge this measly old price of 6 because I'm a price maker. I'm going to dash up until I hit the demand curve, and I'm going to charge a price of 9. So 9 times 6, my total revenue is going to be 54. My total cost, I dash up until I hit average total cost. It just so happens that my average total cost here is the same as my marginal cost. So I'm going to intersect it at the same point. So my average total cost is going to be 6. 6 times 6, my total cost is going to be $36, or the blue box. My profit is going to be 54 minus 36, this box right here. Remember, it's the difference between my price and my average total cost, which is 9 to 6. So it's 3 times 6, or $18. So my profit or loss per unit is going to be 18 divided by 6. So $3 per unit. I'm going to pause real quick. All right, I'm back. Okay, so there you go. Not so bad, right? Now, I need to share 2 more concepts with you, so I'll try to make them pretty quick because we'll go over and flesh them out in class. Monopolies are inefficient. Generally speaking, I know before I said they could be good, but generally inefficient for 2 reasons. Reason number 1 is they charge a higher price than what the market demands, right? We know supply equals demand is where they should charge a price, but they push that price up. We'll talk about that in a second. Second, they don't produce the quantity that society desires. So because they don't produce enough, they're not allocatively efficient. In addition, they produce at a higher cost than the minimum average total cost curve. So they are not productively efficient. So they're operating where they charge a high price, produce too little, not allocatively efficient, and where they produce at a higher cost than minimum ATC, which we know is where MC equals ATC. So they're not productively efficient. So let's just compare the 2 real quick. This isn't a perfect comparison, but keep in mind that marginal cost is our sneaky supply curve, right? So if we hold that to be true, then we can learn a couple of things. We know in a perfect competition, this is a industry, obviously, market, our consumer surplus is here, our producer surplus down here, and we have no deadweight loss because we're producing where demand equals supply at equilibrium. At this point, everyone who wants a good gets a good, and every business willing to produce a good gets a profit. So everyone is happy, completely allocatively and productively efficient at the intersection between sneaky supply, marginal cost, and demand. Okay? So there we go. They're maximized. If we just add our marginal revenue curve here and we look at this as a monopoly, again, our marginal curve would have like a ladle and we'd have an ATC here, but let's just ignore all of that. What's happening? Well, we're actually producing where MR equals MC, right? Not where demand equals MC. So our quantity is below where it should be. We're producing at QM instead of QPC. So we're underproducing. We should be, if we're allocatively efficient, where supply equals demand, or where marginal cost, sneaky supply, equals demand. We're not producing there. We're producing where MR equals MC. Profit maximizing? Yes. Allocatively efficient? Definitely not. We're also charging a higher price because we're at this quantity. We dash up the demand curve allows us to charge a price of PM instead of a price of PPC. So our price is too high. Profit maximizing? Absolutely. Allocatively efficient? No. At MR equals MC, monopolies will charge too high of a price and produce too little to be considered allocatively efficient. What about consumer and producer surplus? Well, consumer surplus we know is below demand, above price. So it's going to be this little box here. Producer surplus is above supply, below price, and it's cut off by the market by quantity there. So it's going to be this box right here, which leaves a little triangle. What's that triangle? Say it with me. Dead weight loss. That's right. Total surplus falls, and now there's dead weight loss when we have a monopoly. Certainly, the producer surplus rises, but dead weight loss exists. So monopolies underproduce, overcharge, decrease in consumer surplus, increasing producer surplus, and causing dead weight loss. Are they productively efficient? If they're productively efficient, then we will be producing where average total cost and marginal cost intersect. Is that where we're producing here? No. Price does not equal minimum ATC. We're producing where MR equals MC. We are not producing, let me throw this on here, we're not producing here. If we were producing at the lowest possible cost, we would be productively efficient. But instead, we are charging this slightly higher cost. So even firms also are not productively efficient, because they do not produce at the minimum ATC. They're not allocatively efficient because supply does not equal demand. Sneaky supply, marginal cost, and demand intersect right here. We should be charging a price of like $6.50, but we're not. We're charging a higher price of $7 and producing a lower quantity of 6. So we're not allocatively efficient either. Price is greater and we're underproducing. So inefficient across the board. And on here, you can identify dead weight loss, which is just going to be this little triangle right here. The difference between where I want to be, sneaky supply and demand, and where I'm at, MR equals MC. Okay, how about a natural monopoly? And this will be our final concept. Well, a natural monopoly looks a little different. Here's how you know a natural monopoly is existing. Our demand equals supply, sneaky supply and demand, where average total cost is still going down. So average total cost doesn't look like a bowl, more like a ramp, right? So if average cost is still going down, this means that this firm could produce at the socially optimal quantity. Sneaky supply equals demand, which would be allocatively efficient. They could do that because costs are still going down, but they're not gonna because it's not profit maximizing. So a natural monopoly is a firm can produce a socially optimal quantity where sneaky supply equals demand, MC equals D, but they don't do it because it's better for them to produce at MR equals MC. In this case, though, it's better to have this firm than to get rid of them. Because of their economies of scale, they will produce what we want at the minimum lowest possible cost. So they can do it. They just won't do it on their own. So this firm, if unregulated, will produce where MR equals MC, which is right here. We'll charge a price of PM, QM and PM. You know that already, right? If we regulate them and make them pay, we call it a fair return. If we make them charge a price of PFR, or fair return price, price ceiling right here, then price will equal ATC, which we know means total revenue, we equal total cost. There'll be a zero economic profit. And then finally, we can put them at the socially optimal point where there will be no dead weight loss, which will be PSO, or price socially optimal, not QSO. Sorry about that. At this point, they will operate at a loss, and that loss will persist. And we'll talk about that in a little bit. Okay, so what happens if the government sets these price at the socially optimal point? At this point, the firm's total revenue will be P times Q. Their total cost, we would dash up to ATC and dash over. So it'd be ATC times Q. So cost will be greater than price. So this box right here would be losses. In the event that we make them charge this price, the firm will operate at a loss. Here's the deal, because that loss is created by government regulation, that loss will persist. Firms will not leave the market changing that loss. So the only way to keep that business afloat would be to subsidize it. So we have this giant monopoly. We make it produce what society needs and wants at the price society needs and wants. MC equals demand, or sneaky supply equals demand. But then we have to give them a subsidy to make that worth their while. Yikes, right? So what should we do? Well, first we have to regulate them, because if we don't, prices will be too high and quantity will be too low, right? We're trying to make monopolies more efficient. Only if they're a natural monopoly, only if they have the potential to produce what society needs and wants at the price and quantity society needs and wants because of their economies of scale. How do we do this? We do this using price ceilings. We do not use taxes, because a tax would increase the cost and just make things worse. Taxes limit supply. Marginal costs would go up, sneaky supply would shift left. We would produce a lower quantity, which is the opposite of what we're doing, what we're trying to do. Where should they place the price ceiling? They have a couple of options. If they place it at the socially optimal place, where price equals MC, or where marginal cost, sneaky supply equals demand, it would be allocatively efficient, but there would be a loss. If they do it at the fair return price, where price equals ATC, or economic profit is zero, there'll be a normal profit there, which means that there'll be a positive accounting profit. You don't have to subsidize. Most of the time, fair return price ceiling is the optimal one. That's it. Whew, that's a lot. 4.2 Khan Academy is posted for you. Next is 4.3. See you in class.